And we have another day where the markets don't seem to want to have conviction. Still searching for that magic catalyst that will help to explain and perhaps also to guide where things go from here after the wild seesaw that we saw in Friday's trade last week. This is Macro Money. I'm Ilya Spivak, head of global macro here at Tasty Live. And what we're going to focus on today is what that catalyst might be. So, as we now sit looking ahead to the rest of the week, we are finally within the gravitational pull of some key macro data. And that, of course, is the service sector ISM report, setting the stage for the U.S. jobs report that comes at us on Friday. And, of course, we will talk about that on the show in excruciating detail later in the week. But today, it is that ISM report that has our attention. So first, we're going to take a look at why it matters. Why should we care about it? What's going on that is going to be influenced by this report, at least maybe, and how it might offer a little bit of clarity to what the markets have been doing. And then look at some scenarios and some leading indicators for what the outcome might actually be. So, why do we care? Take a look at what has been the driving catalyst for stock markets in recent weeks. In the blue there is the S&P 500, of course. The gray bars are the outlook for Fed monetary policy for this year as they are priced into Fed funds futures. The yellow is next year, and the orange line is the sum of the two. If we notice what's been occurring here, we can see that the outlook for this year has been basically steady since the middle of April. So we're talking 6 weeks at this point, a little bit more, that the outlook for this year has been effectively flat. It's calling for about 33, 34, given the day, basis points in rate cuts. That implies one standard-sized quarter point or 25 basis point cut and about a 50-50 shot at a second one. That has been the baseline. It has been unmoved. One might argue the reason it has been unmoved is because we got some hot CPI data that got us there in April. We then had a Fed meeting in May where the Fed whined and moaned about how inflation has stopped moving lower and basically set up a higher for longer dynamic where they said, look, we don't want to hike. We think that rates at current levels will eventually do what we want them to do. But we're also not comfortable cutting because we don't have the conviction that we need to do that. We don't yet feel like inflation is on a glide path that is certain to our 2% inflation target. And what that seems to have done is shifted the object of speculation. We've locked in for this year. That admission by the Fed in the wake of that data from CPI in April gave us what is essentially the Fed wants to cut. They may do a performative cut this year at some point. Right now it is fully baked in by around November, December, with some optionality on September, though that's less likely. And that's where we're going to be. This desire to wait longer and see and get conviction seemingly has shifted the onus into 2025. And we can see by looking at the yellow bars there, that's the bit that's been in motion. So when you look at the cumulative of the two, how much in rate cuts are we going to get between now and the end of next year? We can see that line has been moving pretty well inversely of the S&P. So where this started to become more dovish, stocks rose. Once it stopped getting more dovish and started going the other way, stocks stopped and have since started to inch back. Now, you've obviously not seen an outright sell off, nor have you seen an outright push into the upside here. We've kind of lingered in an area. And so this is why we care about this ISM data in terms of its ability to influence this calculus. If this now moves higher because of this ISM data, meaning fewer cuts for next year, that seems likely to tip stocks lower. And if it moves back down, it seems likely to give stocks a tailwind. That's our overall framing. Where is inflation coming from? Why is the Fed not confident here? What is it that they're struggling to achieve? Well, just to quickly have a look at what we're seeing here, this is the latest on the Fed's favored gauge of inflation, the PCE index, where we can see housing is still a meaningful component, but it's been basically unchanged from the top of where inflation peaked and into now. Largely reflects lingering effects from COVID, coupled with the Fed's own rate hike cycle, making mortgages so expensive that both buyers and sellers have been pushed out of the market. Inventories are very low. And so that part of it is largely out of the Fed's own hands until they actually cut rates and start to unlock that market's ability through buying and selling to clear itself. The big piece of the story is the core services sector. So services excluding energy and excluding food. And for that matter, excluding housing, of course. So this is the main story here still. And this is the part that the Fed desperately needs to start working if it wants to get disinflation back on track. The last PCE numbers gave us a third consecutive month at 2.8% year on year on the core PCE growth rate. So ostensibly, disinflation has run aground. It's not an economy that's reinflating, and has certainly come a very long way from the inflationary peaks around 7%. But progress is struggling to keep going. We can see this in the latest set of PCE numbers broken down to reveal near-term dynamics. And this is something that the Fed talks about doing in their calculus all the time, where they say, we take the 3-month change and then we annualize it to see what the year-on-year rate over just these 3 months is looking like, or 6 months. Notice what we're seeing. On the bottom is the year-on-year rate. We can see it doing the flat line at 2.8% here. Here are the month-on-month changes. They're helpfully at least trending lower. But when we look at the trajectory in 3 and 6 month inflation, it has some green shoots, but it isn't conviction, seemingly. The 3-month annualized is the sequence of these blue bars here, and you can see at least in April that seemed to ease back. But the 6-month continues to march higher, even in the latest set of data. So it doesn't look yet like the Fed is going to have the confidence to say, this is unmistakable disinflation. We can begin to start to talk about cuts in a more immediate, more earnest way. That's the stage setting. This is where this ISM data comes in. We saw the manufacturing index come out earlier in the week. Now we're going to be looking for the services. The manufacturing index actually ended up being weaker than expected. The expectation was for a 49 handle on that number. It came in under that, so weaker than anticipated. And we'll unpack that in just a moment. On the service sector side, we are looking for a bit of a pickup. In April, both sectors slipped into contraction territory, that is below the 50 line on this index, which is done the same way that the PMIs are done for S&P Global, the ones that we usually watch, where over 50 is growth, under 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. So for the manufacturing side, just as an exhibit here, we saw a pop into expansion in March that then gave way back to contraction in May. And of course, that May number was a more pronounced pace of contraction than April, where we kind of lost this brief foray into attempted growth. So for the past 2 months, manufacturing has been contracting again, extending what was this anemic situation here, and at a faster rate. In April, services also very briefly dipped into contraction territory. It had been the thing that was holding up the economy. And of course, the service sector in general is much bigger in terms of its contribution to growth and to employment than is manufacturing. Manufacturing is maybe about 20% of the economy. Agriculture is maybe 10. The service sector is something like 70. Not surprisingly, of course, that's where inflation, as we just saw moments ago, remains stuck, holding up overall levels. And so what we're looking at this month is for the service sector to come out of contraction territory, nudge back up to 50.5. So a little bit of growth, not a lot, but pushing back into positive territory. This is made all the more important considering the price index within this report. You can see that in this choppy line right here. That tends to run about 2 months ahead of both CPI and PCE. Tends to anticipate their movements by about 2 months or so. Obviously, it's not a perfect thing. You can see there's lots and lots of chop, but you can see at the big inflection points here, it tends to be an important indicator. And so whatever happens with this report may be a very significant input into the Fed rate cut calculus that has been so important for driving stock markets. Now, here's where this gets interesting. We just said that for the manufacturing side in May, the situation was worse than expected. At 48.7, not only is it a contraction, but it's faster contraction than the markets were penciling in. Well, let's look at some of these internals. Why was it so weak? It looks like the biggest bit was a very rapid acceleration in the pace of contraction of new orders. So again, this is a scale where 50 is neutral, above it is growth, under it is contraction. For the past 2 months, we can see new orders on the manufacturing side have been shrinking, but in May, they were shrinking at a blistering speed. That gives you, of course, diminished economic activity in the sector. If people aren't ordering things and buying them, well, what's there to do? Nevertheless, the inflation components of this report remained elevated. The price part only came down a little bit. This is still if this was the highest in a year, this is the second highest in a year. Reading on the inflation component of the manufacturing ISM story. And on top of it, employment surged. So the pace of hiring here jumped rapidly. In fact, it's the first time that it's been above 50 since September of last year, meaning all of this was employment shrinking, just at various speeds. This is employment growing, which of course is something that's likely to put some pressure on wages, which again is inflationary. So even though you have weakness in the headline number, the inflation aspects of the report are not anything the Fed would want to see. We saw this same story in the ISM services numbers last month. Notice that 1 month in contraction after so many in positive territory with 50.5 expected this time. That weakness came with a services component that was nevertheless blistering hot. And so again, this seems to suggest that growth this way or that isn't really diluting the inflationary stickiness that we're seeing. What's more, if we take a look at the overall story for U.S. economic data, we seem to have crossed an interesting crossroads here. Notice that when you look at the 20-day moving average for this series from Citigroup here, you find that when it moves through that average, it tends to have follow through in whatever direction. So what does that mean? 20-day moving average is about a month's worth of days, 5 days a week, 4 weeks, 4 times 5. Obviously, economic data is on a broadly monthly cycle. You get about a month of data, then you get the next month's data, then you get the next month's data. Very few economic reports come out with weekly updates. The really big weighty ones, including policy announcements, tend to be a monthly affair. And there's a smattering of quarterly ones. But most market-moving economic data is on a monthly cycle, which means that analysts adjust their expectations and recalibrate their models with a monthly cycle as well. New numbers come in, they're updated. So when this surprise index moves through its 1 month average, what that tends to suggest, quite logically, is that there is some sort of a readjusting in the relationship between realized results and what the models were calling for, and that those shifts occur with about a month-long window for readjustment. So when you cross the 20-day moving average here, you get upside follow-through. There's a run of U.S. economic data getting better than expected because whatever they were tuned to here as far as expectations were not the right thing. You go back the other way here. When you break down, there's extension lower, then higher, then lower, then higher, then lower, higher, lower, and now again higher. So although U.S. economic data has been deteriorating relative to forecasts since about mid-April, 2 weeks ago or so, it seems to have crossed back the other way, suggesting what you might be seeing is something reminiscent of this, or this, or this. And what that is starting to tell you is perhaps U.S. economic data is beginning to tilt in the direction of being better than expected, or at least relative improvement compared with forecasts. We, of course, saw this in spades 2 weeks ago, where this really started to get legs behind the turn in the relationship with expectations with May's PMI data, an analog of the ISM report, which comes out earlier. We mentioned it near the top of the show. It was white hot, blisteringly better than expected. So 54.8 on services versus 51 expected. 54.4 on the composite as driven by services. Much better than the 51.1 expected. We just saw a final revision of the manufacturing one yesterday, and it was nudged up to 51.3. Better even than the initially reported number of 50 and change, which was itself better than the 50 flat result expected. So the message here was overwhelmingly one of the economy accelerated with gusto in May, according to this. Now, we saw with the manufacturing ISM report, differences in calculations matter. That did not give us the kind of optimistic view of manufacturing that S&P Global did. But also S&P Global said that most of the chipper action was, of course, in services. That doesn't mean that this incoming service sector number needs to be as good as these. But if it's better than expected, well, then we're in an interesting sort of situation, because what this report showed, among other things, it too has sub-indexes for the price components, and it very helpfully unpacks the prices faced by businesses, so wholesale, and what they're actually passing through to the consumer. Notice, all of these remain elevated, or at least as elevated as they've been for the past year, year and a half. None of them have really meaningfully fallen off. And all of them in the month of May, save for manufacturing output prices, where it seems like the pass through was not accelerated. All of them are either pointing higher or holding steady in terms of the pace of inflation. So you can see manufacturing input prices, inflation accelerated. Manufacturing output prices, the pass through softened a bit, which, by the way, is something that we have seen before. The pass through on the manufacturing side can sometimes get a little dicey. We can see periods here, for example, where you have rising things occurring into the input side, for example, here, and there is pass through or there isn't. So here, for example, there is, and in bouts on the way down here, there clearly isn't. So when you look at this, then you get the sense that, okay, manufacturing is maybe a little bit fuzzy. On the services side, what you clearly see is here's input cost and services. They too rose last month, according to S&P, and the prices charged likewise warmed up. So you get the sense that there is still quite a bit of locked up inflation here that may set the stage for the ISM numbers to echo the same. So all of this seems to be starting to triangulate in a direction of maybe not necessarily a blowout ISM number. Though, of course, if the data continues to improve relative to forecast, that's a live risk. But at least the kind of ISM number that doesn't give the Fed any greater confidence to cut rates and keeps the worry that the stimulus onset is going to keep getting pushed back and back and back, keeps that worry alive, especially as we head into the Fed's monetary policy announcement next week. So with that in mind, as ever, the focus becomes this. Will we get the kind of ISM survey? Again, this is the service sector, so it's very much relevant for exactly this. Will we get the kind of survey that tells us the Fed is in a position to cut? Or will we get the kind of thing that is strong enough that this cumulative number comes back in? Let's say even just here, and resets to where it was somewhere around late April, early May, or indeed just 2 weeks ago. And if that's what we see, stocks might very well be in trouble, while the US dollar might well try to make another run toward the top side. And that is macro money for today. As ever, we are here Monday through Thursday, right after Overtime, a show that I co-host with Chris Vecchio and Dylan Radigan, looking at the Wall Street close and what may follow thereafter. I am likewise on with Chris for Futures Power Hour on Fridays, on with Victor Jones for The Price of Truth on Wednesdays, back on with Victor and Tom for First Call on Sundays, writing for the news and insights portion of tastylive.com, and opining sporadically on the platform formerly known as Twitter at Ilias Pivac. Thanks very much for joining. Overtime and macro money are back tomorrow. See you then.